On behalf of the Department of Financial Services, welcome everybody here. Welcome our witnesses. Thank you for being here. We're obviously starting the first of 2 days of hearings on the regulation of virtual currencies. As you may know, over the last 6 months, our agency has been conducting an extensive inquiry into virtual currencies. We've had dozens and dozens of meetings with a wide range of industry participants. We've spoken to leading academics and law enforcement officials, and we've reviewed thousands of pages of documents, reports, and other materials. Now, today's public hearing is really the next step in that inquiry. Ultimately, it is our expectation at DFS that the information we're going to gather in this fact-finding effort will allow us to put forward, during the course of 2014, a proposed regulatory framework for virtual currency firms operating in New York. I believe we'd be the first state in the nation to do that. Clearly, when it comes to virtual currencies, let's admit it, regulators, all of us, are in new and somewhat uncharted waters. However, I should say that the legal action that we saw yesterday underscores how critically important it is that we put in place guardrails for this industry to help root out money laundering and other misconduct. Now, the goal of these hearings is to really provide a 360-degree view of this new and constantly evolving industry, both its promise and its potential pitfalls. We've sought to bring together a diverse group of witnesses, they bring with them each an array of different perspectives. We believed that it was important to hear from law enforcement and regulators. We'll hear from some law enforcement tomorrow. But we also wanted to bring in investors, technologists, merchants, and a number of other individuals on the ground floor of this fledgling industry to provide their views. Of course, this hearing is not going to be the first, and it's certainly not going to be the last word on virtual currencies. So let me just step back then and say that our agency approaches the issue of virtual currency without any prejudgments. A lot of people, I think, initially react to something new like this, something so out of the box, with immediate skepticism. And I think that all of us should resist being overtaken by that urge. It's hard to say precisely what the future holds for virtual currency and its associated technology. Currently, there is not widespread adoption of virtual currencies among the general public, that's clear, and some doubt whether there ever will be. But the same has been said for many other technologies that have since become everyday features of all of our lives. Now, it's clear at this point that some very thoughtful and innovative people, many of them here today, are taking virtual currencies very seriously. And they are putting significant amounts of time, attention, and capital behind the industry. Now, DFS as a regulator obviously can't turn a blind eye to something like that. We don't really have a choice. Now, the Department of Financial Services, like many other state regulators, has a specific legal responsibility to license and regulate money transmission. And to the extent that some virtual currency service providers are engaged in money transmission, we do have an important role in writing and enforcing the rules of the game for financial firms. Our role is probably best described as a referee. We want to make sure everyone is playing by the same rules and preventing misconduct, such as money laundering. But at the same time, we also want to make sure that we don't clip the wings of a fledgling technology before it ever gets off the ground. We want to make certain that New York remains a hub for innovation and a magnet for new technology firms. Indeed, virtual currency could ultimately have a number of benefits for our financial system. It could force the traditional payments community, for one, to up its game in terms of the speed, affordability, and reliability of financial transactions. I think many consumers, myself included, are perplexed that in a world where information travels around the globe in a matter of milliseconds, it can often take several days to simply transfer money to a friend's bank account. Moreover, the open source nature of this technology, its relatively low financial barriers to entry, and the nascent nature of the industry mean that it's constantly evolving. The virtual currency industry, as currently constituted, may or may not ultimately see widespread adoption among the general public. I think that's open for debate. There are, for example, serious questions about whether, given its price volatility, it can serve as a stable source of value for transactions. But regardless of that, there might be, at the very least, a kernel of something there that has a profound impact on the future of payments technology and the financial system. That's why we want to proceed without any prejudgments. By the same token, however, regulators have to remain vigilant about the potential dangers that the current level of anonymity provided by virtual currencies presents for money laundering, drug trafficking, gun running, and other illegal activities. No industry should be defined entirely by its bad actors, but it's very clear that there are serious and documented dangers about the use of virtual currencies to subvert critical anti-money laundering requirements. There are, of course, vulnerabilities and dangers associated with money laundering in the traditional financial system, such as at banks. As many of you may know, that's an area where we've been active at the Department of Financial Services. But one issue that we have to consider with virtual currency firms, unlike banks or traditional money transmitters, is that there is not currently a robust regulatory regime to help spot red flags and root out illegal activity. Right now, the regulation of virtual currency industry is still akin to a virtual Wild West. That lack of regulation, however, is simply not tenable for the long term, and I think it's already starting to change. Fashioning appropriate guardrails for virtual currencies present challenging questions for all of us as regulators. Virtual currency is not easily categorized within the divisions we traditionally think about when it comes to the financial system, such as banks, insurers, or money transmitters. In many ways, it's neither fish nor fowl. And while we want to set up clear rules of the road, we also want to preserve sufficient flexibility given the constantly evolving nature of this new technology. That's in part why we're evaluating whether our agency should issue a so-called bit license, specifically tailored to virtual currencies. When people say the word money transmission, they usually think of, if anything at all, firms that were formed more than 150 years ago when our country was still exploring the western frontier. The question then is what type of licensing, examination, and collateral requirements for the virtual currency industry will provide appropriate guardrails to protect consumers and our national security without stifling beneficial innovation. There is, we acknowledge, distrust among some in the virtual currency community about regulation. However, we believe that for a number of reasons, putting in place appropriate regulatory safeguards for virtual currencies will ultimately be beneficial to the long-term strength of the industry itself. First, to state the obvious, serving as a money changer of choice for terrorists, drug smugglers, illegal weapons dealers, money launderers, human traffickers, and the like can expose and will expose the virtual currency industry to extraordinarily serious criminal penalties. Taking steps to root out illegal activity is both a legal and a business imperative for virtual currency firms. Second, safety and soundness requirements help build greater confidence among customers that the funds that they entrust to virtual currency companies won't get caught in a virtual black hole. Indeed, some consumers have expressed concerns about how quickly their virtual currency transactions are processed. There have also been public reports of virtual currency lost, perhaps irretrievably, through hacking and other cybersecurity vulnerabilities. Addressing those issues through enhanced safety and soundness requirements would be important to building greater confidence in this technology among the general public and promoting wider adoption. We very much look forward to a spirited discussion on all of these issues with our first panel, but also with the panels to come today and tomorrow. And I want to now, again, thank each of the panelists. I know you took time out of your very hectic and busy schedules to be here, and I'll introduce each of you. First, we have Barry Silbert, who is the founder and CEO of SecondMarket and the founder of the Bitcoin Investment Trust. Welcome, Mr. Silbert. Next, we have Jeremy Liew, who is a partner at Lightspeed Venture Partners. Welcome. Then we have Fred Wilson, who is a partner at Union Square Ventures. Welcome, Mr. Wilson. And we have Cameron and Tyler Winklevoss, who are principals of Winklevoss Capital Management. Welcome to both of you. Now, this is just a technicality, but we do this at every hearing. I'm going to swear you in. It's quite simple. If you'll just rise and raise your right hand. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth, so help you God? Thank you. Please have a seat. Let me also, just as a housekeeping matter, introduce the very fine people who are up here with me and who actually do all the really hard work. To my left is Danny Alter. He's the General Counsel of the Department of Financial Services. To my immediate right is Maria Philippakis, who is an Executive Deputy Superintendent who runs our Capital Markets Division. And to her right is Dana Syracuse, who's the Deputy General Counsel at the Department. So with all that said, why don't we kick it off and hear some opening statements. We'll turn it over to you to start, Mr. Silbert. Thank you.
Superintendent Lawsky and members of your staff, my name is Barry Silbert, and I'm the founder and CEO of SecondMarket, a platform that enables private companies and investment funds to more efficiently raise capital and provide liquidity to their stakeholders. In addition to founding SecondMarket, I also helped create the Bitcoin Investment Trust, also known as the BIT, which is a private investment vehicle that enables institutional and sophisticated individual investors to invest in Bitcoin. We created the BIT to provide investors with a professional solution to gain exposure to Bitcoin in a structure that solved for many of the problems of direct Bitcoin investments, such as having to wire funds to unregulated exchanges overseas, as well as concerns around Bitcoin safekeeping and ownership. By transacting through SecondMarket, a registered broker-dealer, BIT investors gain protection of regulatory oversight, compliance procedures, and a FINRA-registered team. In the 4 months since launch, the BIT's assets under management have grown to over 70,000 Bitcoin, which is approximately $60 million at today's price. Investors include family offices, private trusts, high-net-worth individuals, all willing to invest at least $25,000. In addition to the foregoing, I'm also an active angel investor in the Bitcoin space via my personal investment vehicle, the Bitcoin Opportunity Fund, with investments in over 20 Bitcoin-related companies, including BitPay, Coinbase, Gift, BitPremier, CoinSetter, ItBit, Ripple Labs, Corbit, and BitPagos. Thank you for the opportunity to participate in this important hearing regarding Bitcoin, the state of the ecosystem, and what regulatory changes might be necessary to adequately protect investors and consumers. I applaud the New York DFS for taking a proactive role with respect to virtual currencies and determining what changes, if necessary, are necessary with respect to the current regulatory scheme. As there remains a high level of uncertainty at the state level regarding the status of virtual currencies from a regulatory perspective, I believe that there is a tremendous opportunity for the DFS to take an approach that can be replicated nationwide. Further, by ensuring that such an approach provides clarity without being overly burdensome, the New York DFS can also promote the state economy by attracting the growing business segment, which I believe will result in meaningful job creation and innovation within our state. As a regulated broker-dealer, subject to oversight by FINRA, SEC, and all 50 state securities regulators, I believe that SecondMarket provides just one example of the policies and procedures that a company can institute to protect investors while complying with existing rules and regulations. I would also like to note that while my activities in the Bitcoin space are extensive, my perspective is that of a CEO of a registered broker-dealer, a creator of a Bitcoin investment vehicle, and an angel investor, but not an operator of a Bitcoin business. As such, my level of familiarity with money transmitter rules is somewhat limited, and my perspective should be taken in that context. Thank you again for asking me to speak today.
Thank you. Thank you, Mr. Silbert. I'll turn it over to you, Mr. Liew, for your opening statement. Thank you.
Helps if I turn it on, apparently. Mr. Superintendent and members of the Department of Financial Services, thank you for inviting me to appear before the Department today to offer my perspective on virtual currencies and to address the topic of appropriate regulation in this area. My name is Jeremy Liew. I've worked in the consumer internet industry for nearly 20 years. Presently, I'm a partner at Lightspeed Venture Partners. Lightspeed has over $2 billion in assets under management and invests primarily in early-stage technology companies, including virtual currency-related companies. I believe that virtual currencies present the opportunity for tremendous innovation that will benefit both consumers and merchants around the world. As an investor, I'm interested in helping facilitate this innovation, leading to value creation and job creation here in the U.S. Today, I'll address some of the advantages and opportunities that I believe virtual currencies present. I'll also address some of the concerns that critics have raised and ways in which I think appropriately tailored regulation could advance positive developments in this area. I'd like to begin by addressing some of the benefits of virtual currencies. First and foremost, virtual currencies such as Bitcoin allow the transfer of value without the use of a third-party intermediary, thereby decreasing transaction costs. They are, as some say, free-ish. Second, virtual currencies allow for the possibility of microtransactions, payments typically less than $1. The current credit card infrastructure is priced in a way that makes this very difficult. Third, virtual currencies, being digital money, allow for the possibility of smart contracts, computer protocols built on top of the virtual currency protocol that can be used to facilitate, verify, execute, and enforce the performance of a contract. Bitcoin is an open source project. As such, it will continue to evolve. As with any technology, from the internet to voice over IP to big data, the full range of possibilities is hard to imagine at the beginning. I expect additional advantages of using virtual currencies to be realized as the technology evolves and matures beyond the infrastructure setup stage. I am aware that a number of concerns have been raised with regard to virtual currencies. For example, much media attention has been focused on outlaw companies such as Liberty Reserve and Silk Road, which facilitated illegal activity. Happily, the people behind these companies have been caught and the companies shut down. We must avoid the lazy temptation to conflate wrongdoing with new technology. Like any new technology, virtual currencies can be used for good or for evil, just as old technology can. We must be careful not to throw out the baby with the bathwater. Some have expressed concerns about Bitcoin's price volatility and how this could make it unsuitable as a payment mechanism. A merchant may not want to take any additional currency risk in addition to their business risk. However, as long as there's a liquid market that will allow a merchant to exchange Bitcoin for fiat immediately upon receipt, they will not be exposed to meaningful currency risk. Moreover, increased investor and regulatory interest in virtual currencies should bolster their legitimacy. Increased legitimacy will, in turn, lead more people and businesses to use virtual currencies, dampening price volatility and creating that more liquid market. I'm also aware of concerns about possible security breaches on virtual currency networks and the need to safeguard against theft and fraud. That is equally true of cash. Security and integrity, specifically security of companies that Lightspeed Venture Partners invests in, is a key diligence area for us. Without it, as an investor, we would also suffer great loss. Turning to the subject of appropriate regulation for virtual currencies, I want to emphasize at the outset that I appreciate that there are various perspectives on how best to regulate virtual currencies. As an investor, there are many areas which I could choose to invest in. The ecosystem around virtual currencies is an area which provides rich opportunity. I think that the overarching principles guiding regulatory efforts in this area should include enforcing the rule of law and collaborating with industry to use existing regulatory guidelines, and only when necessary, developing new guidelines that are clear and not overly burdensome. This approach will stimulate the most innovation and creativity. Regulatory clarity is most important for startups. Today, there are 3 core questions for a Bitcoin user to answer. How do I get Bitcoin? Through an exchange. How do I hold Bitcoin? In a wallet. How do I spend Bitcoin? Through a payment processor. I believe that it is no accident that there is greatest clarity around payment processing regulation, and the world leaders in Bitcoin processing, Coinbase and BitPay, are based here in the US. There is the least regulatory clarity around Bitcoin exchanges, and as a result, there is no leading American-based Bitcoin exchange. American citizens who wish to use an exchange have to rely on one based in Slovenia or Japan. If we had the regulatory clarity to enable a US-based Bitcoin exchange, there would be many benefits for the Bitcoin ecosystem, for US citizens, and for US businesses. The Department has raised several questions regarding specific aspects of virtual currency regulation. My present feeling is that regulators should treat virtual currencies in much the same way they treat other types of currency in considering regulation. I understand that the Department is considering the feasibility of issuing a bit license specific to virtual currency transactions. It's hard to know how to react to this without knowing more about it. Conceptually, I'd be open to the possibility of a bit license framework, provided that it is tailored appropriately. My sense, however, is that it would be easier to use the existing regulatory frameworks to prohibit bad behavior, such as money laundering, rather than developing new regulatory frameworks specifically geared to virtual currencies. Regarding consumer protection guidelines, my feeling is that existing regulatory frameworks are adequate for addressing fraud. I think that virtual currency entities should not be required to follow specific regulatory examination requirements, as existing frameworks are adequate. To the extent that new regulations are created, the guidelines should be clear as to what activities are covered and to whom the regulations apply. In terms of the types of virtual currency transactions and activities that should require regulation, I think that the focus should be on potential money laundering and terrorist financing transactions, as is the case with current regulations governing money services businesses. Virtual currencies represent an innovative alternative to traditional money systems, with significant potential benefits for consumers and businesses. I'm aware of the concerns that have been raised and the challenges that regulators face in deciding how best to regulate in this rapidly evolving space. However, I think that an appropriate balance can be struck between enforcing the rule of law and promoting innovation and legitimate commercial uses of virtual currencies, as I think you reflected this in your opening statements. Thank you for inviting me to appear, and I look forward to answering questions.
Thank you very much, Mr. Liew. And I'll just mention that I think most of you submitted written testimony as well, and we'll take that all and put it in our record as well, so that'll all be there permanently for anyone else to see. So thank you. Mr. Wilson.
I'd like to thank Superintendent Losky and his colleagues for inviting me to testify here today. The reason that I wanted to come and talk at this hearing is that I have been investing in, my name is Fred Wilson, and I'm a venture capitalist. I've been investing in technology and internet companies for almost 30 years. The reason I wanted to come testify today is that the single biggest opportunity that I've come across in my career happened in the early 90s with the advent of the commercial internet. And the thing that was so important about the advent of the commercial internet was that it enabled global permissionless innovation, meaning that anybody who wanted to deploy software on a web server anywhere in the world could immediately access customers everywhere in the world. And as Jeremy mentioned, there are no intermediaries required. The internet is a peer-to-peer system. It is distributed, and it is operated via many open source technologies and protocols. Now, virtual currencies, particularly Bitcoin, remind me so much of that time, the early 90s. And I believe that they represent exactly the kind of potential for innovation in the areas of financial and transaction markets and services that the internet opened up when it came of age. I think that we face all the same risks and all the same opportunities. And I was very heartened by your comments, Superintendent Losky, because I think that you recognize that while we need to regulate this kind of innovation, we need to do it in a way that doesn't reduce the amount of innovation that happens. And I think in particular, we need to regulate at the edges of a system like the internet or Bitcoin, but we should not regulate how the system itself operates. So, as Jeremy mentioned, things like anti-money laundering, know your customer, and capital requirements, and the kinds of things that the current regulatory regime already requires are probably the right kinds of regulations to put in place for Bitcoin as well, and all virtual currencies. I think Bitcoin is the most promising and certainly the most widely adopted of all virtual currencies. I think we could see the development of multiple virtual currencies, although I suspect that the technological framework will be quite similar to what Bitcoin uses. And I think we are at the beginning of a very promising and exciting time, not just for investors, clearly for investors, but I think also for society. I think that much good will come of this in the same way that much good has come of the internet. And it's important, and I trust that you all will ensure that we don't get in the way of that good from happening. Thank you very much.
Thank you, Mr. Wilson, for that testimony. I'll turn it over to Cameron Winklevoss. I don't know if you were both planning to testify one at a time. That's fine, or however you want to do it.
I was just going to read a statement on behalf of both of us.
Great.
Okay.
Thank you.
Good morning, Superintendent Losky, Mr. Alter, Ms. Filipakis, and Mr. Syracuse, and other members of the Department of Financial Services. My brother and I thank you for giving us the opportunity to appear before you today. We are encouraged that the Department has assumed a leadership role in the consideration of how state agencies should regulate Bitcoin service providers. With your work over the last 6 months and hearings this week, New York has emerged as a leader in pushing for regulatory certainty on a state level, thereby fostering the continued growth of the Bitcoin ecosystem. By way of introduction to our involvement with Bitcoin, we are principals of Winklevoss Capital Management, a family office in New York that invests in emerging technologies. Since 2012, we've also been direct investors in Bitcoin as an asset. Our experience has given us insight into Bitcoins as an investment opportunity and the Bitcoin network as a technological breakthrough in payment systems. We are pleased with the continued acceptance of Bitcoin in the payment and retail industry. In particular, Overstock.com and Tiger Direct recently became the first large-scale U.S. retailers to accept Bitcoins. In its first 24 hours of Bitcoin business, Overstock did $125,000 worth of Bitcoin paid sales. A week later, Tiger Direct doubled that sum in its first 24 hours. More retailers and other businesses are sure to follow suit. In terms of Bitcoin as investment assets, we believe the Winklevoss Bitcoin Trust, for which we have filed a registration statement with the SEC, will allow retail and institutional investors the opportunity to gain exposure to this asset class in a more safe, secure, and accessible manner. Bitcoins have a particular risk-return profile that appeals to many investors. The Bitcoin ETF will give Main Street and Wall Street the opportunity to analyze that profile and make an investment decision through an offering that has been reviewed by the SEC. Shares in the Bitcoin ETF will trade on a national securities exchange like any other exchange-traded fund and will feature a prospectus that fully discloses the risks involved and periodic reporting that provides updates. Notwithstanding its potential as a payment system or investment, ultimately, regulation will play the biggest role in Bitcoin's forthcoming evolution. As both proponents of and investors in Bitcoin, we acknowledge that the regulatory environment must both be certain and carefully constructed for Bitcoin users and startups. Media reports following last year's U.S. Senate hearings indicate that Senator Tom Carper and FinCEN Director Jennifer Shasky both believe that existing federal regulation is sufficient and can be applied to Bitcoin. We agree. We also believe the same is true of state law. To the extent that Bitcoin-specific adjustments are needed for the application of money transmission licensing or any other regulatory requirements, a type of state bit license may be very helpful in accomplishing that. As set forth in our written testimony, we believe exchanges on which users trade Bitcoins for U.S. dollars, as well as businesses that directly buy Bitcoins from and sell Bitcoins to customers for U.S. dollars, are appropriate subjects for both federal and state regulation. We also believe that regulators must be aware that Bitcoin is an emerging technology and that over-regulation could cripple its development. New York is one of the locations of choice for Bitcoin entrepreneurs and Bitcoin-related startups. We encourage the department to strive to find the appropriate balance that protects consumers while promoting the growth of the Bitcoin ecosystem and its participants. We look forward to working with the department and other state entities in their consideration of appropriate regulation and welcome any questions you might have.
Okay, well, thank you very much. I'm now going to ask a few questions of the panel, and I hope you'll take this in the right spirit, which is these questions are intended to be, this Q&A should be casual. This is not a congressional hearing, and we really actually just want to know what you think. If you think a question doesn't make sense exactly and you want to change the question a little bit and answer it a different way, just tell us, and that's fine. I think most productive for us as we consider how we're going to regulate Bitcoin is to really hear what you think. And so please don't hold back, and we'll give you all the time you need. I guess, look, the first question is the obvious one that's on everyone's mind. It was sort of unexpected yesterday, but with the arrests we saw yesterday, obviously that's put a bit of a cloud hanging over the industry right now. And my question for each of you is to get your opinion on how you react to that yesterday. Should we treat it as, I think as one of you said earlier, this is just one form of technology, and any technology you choose is going to have people who are bad people who are going to use it, allegedly anyway, in bad ways. And so, drug dealers use cell phones. It doesn't mean we condemn the cell phone industry. And terrorists use computers. It doesn't mean we say the internet is bad. So on the other hand, there are arguments that some of the unique characteristics of virtual currency in its current form are more susceptible to anonymity or to being altered in a way that allow people to remain at least pseudonymous, and that raises significant questions. And what we don't want is to have a world where Bitcoin or virtual currency are a haven for those who are committing illicit activities. So how do each of you react to what we saw yesterday and what we learned yesterday and what it means for Bitcoin or virtual currency and its future? So we'll start with Mr. Silbert.
So I've not read the complaint yet, so my knowledge is really based on headlines and press coverage. But it seems as if those who are kind of accused or convicted, it seems like the system is working. And so I think it further supports that bad guys are going to do bad things, and they're going to use whatever technology is available to them. But I view it as, again, if the allegations are true and they're convicted, the system works.
I take from that a little bit, if we can just have a little dialogue. You're saying that where Bitcoin maybe 2-3 years ago, probably a lot of people in this room, excluding those at the table, probably wouldn't have heard of it. I know I certainly hadn't heard of it 2-3 years ago. Where maybe now that it's becoming more mainstream, now that there are more eyes watching, that there will be quicker and more robust reaction when there's illicit activities in that area.
So yes. Now, again, I haven't read the complaint, so I don't know how those who were kind of charged were caught, but I'm assuming it's given the trackable nature of Bitcoin. And at the end of the day, Bitcoin itself is a very traceable currency, and the identity behind the wallet may not be obvious, but if you want to get your money in or out of Bitcoin, you are going to have to reveal your identity. I'm assuming that played a part in how these individuals were caught.
Yeah. Mr. Liew, you want to take any part of those questions?
I'd echo the point that it appears as though the existing framework of regulation and law enforcement has been working well in this regard, and so I think that sort of speaks to the satisfactory nature of the existing regulatory frameworks. I'd also point out that I think that we've seen over time a change in the character of the people being involved in Bitcoin, and whereas when it first started out, it was a academic kind of novelty. Over time, it attracted different people for different reasons. And I'd say, the very first, if you think about what Bitcoin, the characteristics that make it interesting, one of them is that it's decentralized and open source. And I think that was the thing that attracted the first set of people to Bitcoin, that took it from, an idea to something. And, a lot of those people were libertarians and radical libertarians. I think the second characteristic of Bitcoin that attracted the second wave of people was this pseudonymity, and people who thought that they could conceal their behavior behind Bitcoin, and the people who were wanting to conceal their behavior behind Bitcoin. But I think what we've seen over the course of the last year and a half has been a set of people who are attracted to the two other aspects of Bitcoin. The first being that it is free-ish. It dramatically reduces transaction costs. And the second being that it's programmable, and it offers the opportunity through that for a lot of additional functionality to be built on top of it. And so you're seeing this kind of change in the nature of the Bitcoin population. And frankly, that's what's interesting to me as an investor, because it turns out that the market of radical libertarians is not very big. And the market of criminals is not very big. But when you're offering free, radically reduced transaction costs, and when you're offering the ability for programmable money that can put a lot of additional functionality on money, then you're talking about a market size of everybody in the world. That's pretty interesting to me as an investor. And I think we're seeing more and more entrepreneurs and investors coming into the market who are attracted to that value proposition, and less so to the idea of pseudonymity.
Would you say, because it feels to me a little like, and I think underlying what you're saying is it may be that Bitcoin and virtual currency are sort of at a little bit of a tipping point right now and can end up going in a number of different directions. And if if I hear you right, if Bitcoin goes the more mainstream direction in favor of a little more regulation, a lot less crime, and enhancing the benefits that it could provide, taking the frictions out of transactions, taking the costs way down for international transfers, that you could see Bitcoin really growing in a way. On the other hand, it could tip the other way, and if Bitcoin continues to be primarily, if the primary benefits Bitcoin ends up providing are the pseudonymity and the sort of an easier place to commit crimes, that it may not end up becoming ubiquitous and thriving and an important new feature. I mean, is that fair to say?
I would recharacterize that slightly. I think that the Bitcoin community is moving in the direction of greater legitimacy of people who are looking to drive economic benefit of the sorts that we were just talking about, and is moving away from the primary benefit being pseudonymity. So I don't think that this is a tipping point where it could go in either direction. I think the trend is very clear.
You think you've tipped?
I think it's going in that direction. I mean, you know, as an investor, I'm sort of putting my money on that case because, like I said, it's simply not that interesting an investment if it doesn't have that sort of market size and that sort of proposition. And so, you know, I think you can even see it in the composition of the Bitcoin Foundation, where you look at the people who are being elected today, they have a very different sort of background than the people who've been elected historically.
Mr. Wilson, do you want to react to the original question or to any of them that followed?
I think the point that Jeremy is making is really an important point. What I was going to tell you is going to sound a little bit repetitive, but I'll say it a little differently. I wrote a blog post a month or so ago where I laid out the five phases of Bitcoin, 3 of which we've gone through, and 2 of which I think we are going to go through shortly. The first phase was the development of the open source community and the Bitcoin protocol, and that was very much sort of a geeky, kind of nerdy, crypto, libertarian kind of thing, and that was 2009 and 2010 broadly. And then the second phase is what I call the vice phase, and that was Silk Road and drug trafficking and gun running, and that was 2010 and 2011. And then the third phase was speculation, trading, price speculation, and we're in that phase. I think we are getting to the end of that phase. That was 2012 and 2013. Wait, hang on, 2009, 2010? No, that's 2013, 2014. And then I think that the next phase, which I think we're entering, is the transactional phase, where we see real merchants accepting Bitcoin for transactions. And we're starting to see some real signs, as others have already mentioned, that that's happening in a big way. And I think that the final phase, and these build on each other, right? They're not, that you don't completely leave one to go to the other, is the phase that Jeremy talked about of programmable money. When money can move via an infrastructure that's programmable the way that Bitcoin and the Internet is, you can build applications. So we'll see someone build the next Ticketmaster on top of the Bitcoin architecture. We'll see somebody build the next stock exchange on top of the Bitcoin architecture. That's what the programmable piece of this is. So I think, and those phases in my mind, think about them in terms of the percentage of people who own Bitcoin or who are mining Bitcoin or who are spending Bitcoin are engaging in that activity, right? So the vice phase is in the rearview mirror. Are people still doing bad things with Bitcoin? Sure. Is the majority of the Bitcoin activity vice? Not a chance. So I think the issue you raise is one that people like to write about, the media likes to write about, makes great headlines, you get a lot of clicks, you can sell a lot of ads, but I think it's in the rearview mirror for the most part in the world of Bitcoin.
And look, I did read the complaint quickly yesterday. It was long, but it is backward looking, so it does support what you're saying.
I think people will still do dumb things.
Of course.
But I don't think the vast majority of people who are owning Bitcoin and spending Bitcoin are doing dumb things right now.
Okay, thank you. I don't know, either of the
Yeah, I agree. I think yesterday was a speed bump. Closure of Silk Road and the subsequent price increase of 10x indicates the demand for Bitcoin is far from illicit activity, but legitimate activity like everyone's discussed.
Would you all agree that one of the promises of Bitcoin is the sort of the programmable stage, the businesses that are going to be potentially built on top of it?
Absolutely. Without a doubt. Yeah, I think the protocol, I think, as a lot of people on the panel have sort of alluded to, it's really hard to imagine what's going to be built, but I think over time it'll become clearer. But that's, I think, sort of the promise there, building on top of the protocol and the rails.
If you had to predict the future, which I guess as investors you often do in your own minds anyway, do you think that we'll see an emergence of a single virtual currency, or do you think we'll always have multiple alternatives? Because if there are multiple alternatives, one thing I'm interested to talk about is, Bitcoin has a public ledger, and that's a very good thing from law enforcement and from a regulatory perspective if we ever need to trace things back. As I understand it, some virtual currencies don't have ledgers and are thus going to be harder to deal with. And so question one, do you think we're going to eventually get to a world where we have a single virtual currency, or will we have competing virtual currencies? And then if so, if it's multiple, I guess my second question is, do you think we should think about requiring or pushing the industry towards at least having public ledgers if you're going to have a virtual currency?
I think so far it seems like Bitcoin has such a sort of large head start and such a wider adoption. I wouldn't say necessarily, though, it will be the only virtual currency, but I think a lot of the potential advantages or differences in other currencies, Bitcoin could sort of pivot or adopt if the sort of the network and miners and people accepted that. I think the public ledger is a very key element of Bitcoin, and I think that's one of probably more can be misunderstood. I think the fact that it's public, it makes it incredibly transparent, and you can trace a Bitcoin from the beginning of time, which is, I think, great, and from a regulatory standpoint, obviously important. So I think probably one of the things we need to do is make sure that Bitcoin, we don't take it sort of, regulate it from being sort of the winner, so to speak, right now, because I think it has a lot of attributes that appeal to technologists, but also make it something that regulators appreciate and want to work with because of the public ledger.
Yeah, I think money has the ultimate network effects. So I think Bitcoin is the runaway winner, and I do believe it's very much a winner-take-all landscape. But if the regulation is so draconian then that Bitcoin can't thrive, then the danger is there's alternatives, like you said, without a public ledger that might have more of a tumbler system where people put their money in and they can redeem, and you can't actually trace where the money's going. So that becomes a possibility if regulation's not thoughtful and circumspect.
I think keeping the word bit and not making it Bitcoin license is probably a good idea, just to leave the availability for some other innovation, because it could happen. It's possible.
Any of our other panelists want to also address that question?
Well, I think on the protocol side, the market, the history of protocols are that it's a winner-take-all. It's HTTP, it's TCP/IP, it's SMTP. So I think on the protocol side, it's going to be Bitcoin. What can emerge in terms of the store of value, the currency component, I think is still TBD. Certainly, Bitcoin seems to be by far and away the most popular virtual currency to own and transact with, and maybe that just will be that way. But I can't say for sure that we don't see other virtual currencies emerge on top of the Bitcoin architecture. And there are some arguments as to why that would be a good thing, and there's arguments on the other side as to why that would not be a good thing. So I think that's less clear, in my mind anyway.
Nothing more to add. Great. I want to turn it over to my colleagues to ask some questions, but let me just ask one more. Do you think it's fair to say, and I think it's in all of your testimony, but I just want to hear if you want to put any gloss on it or any nuances, that going forward, the virtual currency world to sort of thrive and succeed and become more mainstream is ultimately going to have to really embrace regulation. Like I think I said in my opening statement, there are some people in the Bitcoin community from the libertarian side of things that want government to just leave it alone, Would you say regulation is both inevitable, but more importantly, actually ultimately going to be crucial for the survival of virtual currency?
I think one of the challenges you have as a regulator with respect to Bitcoin is that it's a global phenomena. And if you look at the landscape, both kind of from a regulation perspective and tax perspective, you're seeing a lot of different approaches to how to regulate Bitcoin and how to tax Bitcoin. And I do believe that, I think Jeremy made the point earlier, that one of the reasons why the dominant exchanges are located overseas is because of the uncertainty around how those businesses should be regulated. And I think, unfortunately, I think that's a missed opportunity, and I do hope that we kind of right the ship and the dominant exchanges end up in the U.S. and, quite frankly, here in New York. So I think over time, the regulators are going to have to come up with a way to treat Bitcoin that is balanced and thoughtful, but also recognize that this is a global phenomena. And as much as certain policymakers, certain regulators may hate the idea of Bitcoin, typically once they dig in, they come to appreciate the power of it, recognizing that the companies are going to get created, jobs are going to get created, innovation is going to happen. We've got to figure out a way to do it in a balanced way so that it happens here in the U.S. and hopefully here in New York.
Mr. Liew?
Speaking selfishly as an investor, I think that having clarity around regulation that's based in the U.S. And here in New York, which can serve as a positive example for other regulatory regimes as they develop around the world, is likely to be a very positive thing. I think that, again, it needs to be balanced and it needs to be appropriate so that the innovation can occur, because if it isn't, then that innovation will occur outside of the boundaries of the U.S. And, again, as an investor, that's less interesting to me, and I frankly think it's less good for consumers.
Mr. Wilson, anything to add?
Yeah, I think it's inevitable that there's going to be regulation. There should be regulation, and clarity is important. The other thing that I think is important is to recognize that many of these new companies are 2, 3, 4-person companies. And it's very difficult for them to do the same thing that J.P. Morgan Chase does. I think when they grow up, they should be expected to do exactly the same thing that J.P. Morgan Chase does. But I think there needs to be some idea of a on-ramp to regulation that is inviting of these young companies to engage with the regulatory environment in a way that they can actually do it. That's the issue. It's not that they don't want to do it. It's like, I got to run my servers, I got to write my code, I got to deal with my customers, and I got to apply for money transfer licenses in all 50 states. And so I just would encourage you all to be mindful of that challenge and not expect a 3-person company to be able to do the same thing that a global company with hundreds of thousands of employees can do. And I think if you do that, I think everything should be just fine.
It's a fair point, and I think the Winklevoss brothers mentioned this in their testimony, in their written testimony as well. Look, we, on the regular old banking side, forget the internet for a minute, and the virtual world, we deal with the mega banks who have thousands and thousands of people working there, but we also deal with about 80 mostly upstate community banks, some of which have 10, 15, 8 employees. And one thing we're always cognizant of is not applying the same compliance costs or imposing the same compliance costs on a J.P. Morgan or a Goldman Sachs that we do these smaller community banks. You would drive them out of business. And sometimes when you see some of the federal regulations that are hitting those smaller community banks, I once got a call from a CEO who said, I now have 3 loan officers and 12 compliance officers. I said to them, well, your business is going to fail under that model. And so I think it's something we're certainly cognizant of. The flip side, of course, is we want to make sure that, yes, there's this on-ramp period, but how do we ensure, again, we're moving away from a world where illicit activities are going on and more towards a world where we're encouraging innovation, we're encouraging exchanges to come to New York, we're encouraging more high-tech companies to come and build new architecture on top of what's already being built here in New York and elsewhere in the U.S., as opposed to pushing it offshore. But it's a very tricky proposition to get that balance right. That's what we're trying to do.
Well, it's good that you already have some examples with the community banks where you understand this and you've come up with ways to deal with it. I think that should be, you know, a roadmap for how to think about some of these really small Bitcoin companies, and so that's very encouraging to hear.
I would add one other point, which is I think the sort of cost part of the regulatory burden is definitely one issue for the small companies. The time part is also another very important point, because these small companies, they're driven on innovation, and the quicker that they can cycle their innovation, the more likely you are to see, you know, really new, interesting, novel ideas coming out of them. And that's why sort of long holding periods and, things that prevent them from getting to market quickly, not cost issues, but time issues that prevent them from getting to market, finding a customer and finding that product market fit, can really dampen innovation as well.
Yeah, I was a good metaphor for this is the music industry. So there are literally thousands of startups that have wanted to create new music listening experiences over the past 15 years, and it takes 2 or 3 years and probably several $1 million of legal fees to get the rights to stream music legally, and most, say 95% of those companies aren't going to build something that more than 5 or 10 or 20,000 people actually even care about. So the idea that you would require every single one of them to get fully licensed by the music industry before they even know if they built something that matters makes no sense. And yet that's how the music industry is operated. And you know, when a startup walks into the offices of a music executive and says, you know, I've been operating for 6 months, now all of a sudden the service is working and we're really successful, and now we need to get rights, the first thing that they're handed with is a lawsuit, right? Like, that's not the right way to engage with a young entrepreneurial company. And so I just think as long as the regulatory environment doesn't behave that way too, and understands that sometimes an entrepreneur needs to build something and put it in the market to see if anybody even cares before they go and ask for the permission to operate, that's actually a good thing, and that we should allow that societally. We should allow that to happen across all industries. And then once it turns out that there's a real business there, the money will come, the regulation will come, and all of that can happen in good time. That's really important.
Yeah,
and a good counterexample that has encouraged that would have been, you know, for instance, Google or Facebook APIs, which are free up to a certain point, and therefore encourage the innovation. But then after after a customer starts to reach a certain size, then it's a business relationship.
Yeah, no, look, I think there's a lesson for regulators in there too, which is, again, our money transmitter rules were written way back, and the process was often much slower, and it frankly didn't matter. It wasn't that the technology of the money transmission that was behind the money transmission businesses we were licensing wasn't changing every few months, and so it didn't matter if the licensing process took a year, 9 months, whatever it is. We, about 2 years ago, when we started to see applications for money transmission from the likes of Google and Facebook and the different wallets that were out there, realized that our normal procedures and our normal processes had to be modernized. They didn't make sense anymore in a digital age, and that by the time we were licensing someone, the technology had changed entirely. It was a fool's errand. So I think we're going to have to, as we consider whether we need a bit license or something like that, we also need to think internally at DFS about how we can be a more modern digital regulator. It's not simply what our rules are, it's also who we employ, how quickly we act, what our reviews are like. There's a lot to do.
Here's one thing to just think about. It would seem to me that step one in a modern regulatory framework would be for an entrepreneur to simply let you know that they're operating in your state. Many entrepreneurs tell me that they don't want to do that because if they were to do that, your response could be, probably wouldn't, but could be, to shut them down immediately. And so that they choose not to do that. If there were a safe harbor of some sort for an entrepreneur who willingly notified you that I am in business, I am operating, and I am operating in your state, and then that there was some time period, a year or 6 months or 12 or 18 months or whatever that time period is, I don't know what it is, for them to move through the licensing process in partnership with you, but that they wouldn't necessarily be shut down. They knew that they wouldn't be shut down for simply reporting that they're operating. Then you would know of everybody who's operating in your state, because there would be no reason not to report. And anybody who chose not to report would clearly be, probably not on the up and up. So something like that is kind of what I'm talking about.
Let me raise you one. How would you react to a safe harbor that if you want to qualify for the safe harbor, you also need to have you need to show some basic level of Bank Secrecy Act, anti-money laundering, compliance rules put in place?
I think the question is how burdensome are those things for a 3 or 4 or 5 person operation, and the lighter that they are, the more that they can be implemented in code as opposed to in labor, and the more that someone could get compliant quickly with those things. I think those are good ideas. I think if it requires somebody to go raise $1 million or hire 5 people, then that could be hard for people, and that again might cause somebody to not self-report. So I think that's really the thing you want to think about is if you can encourage people to be compliant, because the cost of being compliant, at least initially, is not very large, and then over time that cost just grows as their business either grows or doesn't grow. I think that's a really good regulatory approach in the modern age.
If I may, but isn't that where you folks come in? Regulation has always been a barrier to entry in every market. And the way you've just described a 2 or 3 person operation can, in worst case scenario, wreak havoc. And we need to be very careful about that, so just simply knowing that someone is operating is not a sufficient safety net. Isn't it the role of the investor to analyze any one particular business plan over another and say, there's something here, and sufficiently fund, and you have a natural selection going on such that when you do open the door, you have adequate money laundering protections, you have adequate solvency, all these things are in place. It'd be great in any industry if you could just open the door and let folks run out and give a shot. But it's one thing when you're dealing with copyright violation. It's another thing when you're dealing with a situation where someone could be sending terrorist funding or engaging in some other illicit activity, which after the fact we found, a few months into it, even though they told us, would be tremendously problematic.
Well, I think there's 2 separate issues that you raise. One is the due diligence that we do when we make an investment, and we certainly do that due diligence. We want to make sure that the company's operating on the up and up, and we want to make sure that they have some compliance in place and they have some know your customer in place or things like that. That may not be the level of compliance and anti-money laundering and know your customer that you might expect. So there could be a gap there. The other issue I think you need to think about is that we may choose not to invest in a company if they can't get licensed by you. And so there's going to be this chicken and egg problem that gets in the way of innovation, where an investor's not going to plunk down the $2 or $3 million that it's going to take to get licensed until you're licensed, and then nobody's going to get funded. So I think these are in some ways theoretical conversations, but I think it's important for you all to understand our world and the world of the entrepreneur, so that at least you can be open-minded to some of these things. You have your job, you got to do it. We got our job, we got to do it. The entrepreneurs have their job, they got to do it. But the more we understand the realities of each other's jobs, I think the better off we're all going to be.
And the one thing that I would just modify Fred's comments is, if that's the condition of entry for a company to be started in the U.S. or in New York, then maybe we won't do it. But if that same company could be started in the U.K. or in Germany or somewhere else, then maybe that innovation just gets pushed offshore, and that seems like a net loss to the U.S.
Look, again, it raises a broader question, and maybe we'll have, and I'd like to get your opinions on this, because maybe we'll have different perspectives. If the choice ultimately is between preventing money laundering on the one hand, and I probably even shouldn't use the word money laundering because it's too nice a word, frankly. Money laundering is the facilitation of all kinds of horrific crimes that I think everyone in this room never wants to see happen. Narco trafficking being one, but acts of terrorism, funding rogue nations, et cetera, all take place through massive money laundering. Now, we have it in our system as we do now, but if to have money laundering, if the choice for the regulator is permit money laundering on the one hand or permit innovation on the other, we're always going to choose squelching the money laundering first. It's not worth it to society to allow money laundering and all of the things it facilitates to persist in order to permit 1,000 flowers to bloom on the innovation side. I think the question is whether we can get somewhere in between where we're very comfortable that we're preventing the money laundering but still allowing innovation. But I guess I would open it up to the panelists. I could start down here. Would you agree that ultimately if the choice is, and maybe this is an unfair question, but ultimately the choice is between getting rid of money laundering but squelching innovation, that we all agree the first job is to get rid of the money laundering, all that it facilitates?
I mean, I agree there's definitely a tension there. Nobody wants to see money laundering. But I think we can reach that middle ground and understanding in hearings like this, just keeping a very open dialogue so it's not us versus them or regulators or this mysterious body. I think we can find that dialogue in middle ground where we can kind of have a firm understanding and we don't lose innovation, but at the same time don't permit criminal behavior.
I agree that I don't think anybody wants money laundering. When we first saw Bitcoin, about a year and a half, almost 2 years ago, I don't think anybody would deny that it was a bit of a wild, wild west because there was no regulation, there was no framework to evaluate the asset, evaluate companies, determine who was compliant, who was not. And a Wild West, attracts cowboys. And I don't think anybody here would disagree with the fact that a sheriff would be a good thing. It's just how do we sort of apply that law? I kind of like the concept that Fred brought up about a bit of a safe harbor where if you register and let us know what you're doing for a certain period of time so we can kind of build our technology and focus on what we do well, and the investors can focus on what they do well, which is basically coming up to speed on Bitcoin, doing the due diligence on the startup, as opposed to having to become also a regulatory expert. I think that will at least allow these sort of nascent companies that are small with small funding from sort of building their technology and seeing if it works, and it also sort of doesn't have to necessarily recreate. Basically, the culture of investors is not to basically be paying millions of dollars into startups to make sure that they're compliant. And I'm not saying that that will always be the case, but I think it's one of the things entrepreneurs have sort of run their head up against is going to investors and saying, I need capital for this and also this huge sum for regulatory compliance and lawyers. Now, I think one potential outcome that could come from the type of regulation that we're talking about is startups that are geared towards helping other startups be compliant. So for just like a startup doesn't, generally speaking, they would outsource their email suite or applications to, let's say, Google Apps. They're not worrying about their IT. They're basically outsourcing that to the cloud. If there's clear regulation, I would not be surprised if there's other companies that come out and say, look, if you're an exchange or you're a money transmitter or you're dealing in Bitcoin and exchanges to fiat, we're going to help you be compliant. We're going to take that, offload that burden from you and take care of that. The problem right now, though, is there's no sort of clear regulation where the companies can basically be licensed as a compliance-type company. So that's just one outcome I see that could potentially solve the problem that we're all talking about here.
It's an interesting idea because certainly there is an entire industry right now helping banks try to stay compliant, for better and worse sometimes, with our BSA AML rules. And certainly there's an industry already out there that could, maybe part of or a piece of it could be spun off more into the virtual world to try and help fledgling companies do that. But it would be a way to ensure that, yes, it's a small company, yes, we want them to innovate, but at the same time, we just can't live in a world where we're going to permit money laundering to go on.
Well, that sounds like a terrible idea to me. You're talking about introducing all of the costs back into the system that we're trying to take out of the system. Okay, let's just understand what we're trying to do with Bitcoin. We're trying to create a world where transactions can move globally for free, okay? And making these companies hire, some outsourced compliance firm is a bad idea. The good idea is to put the compliance into the code. Okay, just yesterday I opened a bank account with Deutsche Bank because I got distributed some stock from a venture fund I'm in, and Deutsche Bank was the agent who was, so I have to open a bank account. I had to fill out 5 separate pieces of paper. I had to file an AML form, I had to file an account opening form, I had to file out a W-9, I had to file out, make sure that I wasn't a partner in some brokerage firm, all this stuff, right? If I could have just authed with my Facebook account, okay, if I could have just gone to the Deutsche Bank website and authed with my Facebook, they would have gotten most of that information directly from Facebook, and they could have onboarded me instantly. That's the idea of putting it into code. Now, you may say, look, Facebook can't act as the know your customer provider for the world. And maybe that's right or maybe that's wrong. I don't know. Maybe LinkedIn plus Facebook plus Google plus my social security number plus my global entry number. I don't know what it is. But something like that could handle, AML, know your customer in code, as opposed to is really heavyweight compliance infrastructure that we're now enforcing on companies, is the right answer. That way you can do compliance at scale for no money, and we can drive the cost down to the consumer of doing transactions down to zero. Of course we need to stop bad people from moving money, but by making me have to fill out 5 forms, I'm a good guy. That's not a good answer in my opinion.
I think that we have a lot of good kind of parallels. The idea that we're going to eliminate money laundering would be wonderful. I mean, I live here too. I think that would be fantastic. But we accept some level of risk in the current regulations. I can leave the country with, up to, I think, $10,000 of cash. So, like, someone decided that $9,999 was acceptable risk, and more than that, we start to have to declare. And I think that principle of, controlling bad behavior, reducing bad behavior, minimizing the risk of bad behavior rather than eliminating bad behavior, that principle which we already apply in other regulations, we should also look at for, when we think about virtual currencies. How that gets instantiated, you guys are the experts. I don't have recommendations for you, but let's just be careful about, trying to eliminate things in one technology where we might take a different approach. And so I do think we can look to the guidance of existing regulation, look to the limits and thresholds of existing regulation, and see how those things could be extended and applied to virtual currency businesses.
The only thing I would add is one of the first steps I think you could make is carving out what is clearly not going to be kind of covered under new regulation. So if you kind of look at the Bitcoin space, you have mining, you have merchants who accept Bitcoin, merchant processors, store of value accounts, exchanges. I think, based on the concerns that I've heard identified so far, I think it's pretty easy to kind of carve out miners. You can carve out merchant processors. You can carve out merchants who accept it. You can carve out consumers who use it. And when we're talking about kind of money laundering and I forgot the term you use,
trafficking.
Narco trafficking. What does that mean?
Trafficking in narcotics.
Okay. Okay.
Usually refers to sort of international cartel type activities,
Gotcha.
Shipping drugs,
Gotcha.
heroin, cocaine.
Yeah, so I think you can, if I think about it, it sounds bad, yeah.
It's bad.
So if you're looking to protect consumers in terms of having money, whether it's in the form of Bitcoin or cash, in an account that's going to get hacked or stolen, that's something that clearly needs to be regulated. If you're talking about the exchanging of Bitcoin into fiat currency, that's something that has to be regulated. So let's kind of narrow the focus to the extent possible on the very few areas where we think we need regulation, and let's be clear as to kind of what is not in that category.
I agree with what Fred said back before about the edges of the system. And it's also the metaphor of the garage. We have to have companies coming out of the garage, otherwise the incumbents who aren't providing all the answers are the only ones who can play. And if we're going to have disruption and innovation, we need that garage metaphor to stay alive.
And just to clarify, if there is sort of, let's say, a sub industry that sort of offloads some sort of compliance, I agree that to the extent that it can be done through code, to the extent that existing companies can do that, I totally agree. Anybody who's sort of try to open up a bank account and fill out all these forms and stuff. I mean, it's a labyrinth. It's hard to navigate, and I don't see that it has to be done more than once. So I do agree that we should try to avoid, excess layers if possible.
It took me 2 weeks to open a new bank account with J.P. Morgan Chase, where I have a number of bank accounts already. That seems ridiculous. I don't know why that's the case, but I think it has to do with know your customer and account onboarding. I sympathize with Jamie Dimon. He runs an overregulated company, in my opinion. As a customer, I can tell you he runs an overregulated company.
I'm not sure I share all the sympathy, but look, I mean, I do share. I agree. It's annoying to have to fill out forms. I mean, but the flip side is, as regulators, we're trying to make sure, not when Fred Wilson opens an account, but someone else. We're 50 yards from the old World Trade Center here, and I think all of us never want to see anything like that happen again. And it would have been a lot harder for 9/11 to ever have occurred had we had the protections in place that would prevent the movement of massive amounts of money around the globe by people who would want to kill everybody in this room. So I think the key is to not create useless regulation, but I think the motives behind a lot of those rules are to ensure we don't miss something again.
Yeah, but global entry, I think, is a good model, right? So I went through a fairly laborious process with the TSA to establish an account and get an identity with them and a known traveler number. Once I've done that, the process of me crossing the border becomes almost instantaneous. I think, and this is probably a federal issue and a state issue, if we could have a similar kind of system for account onboarding, where once you've established yourself as a known, trusted banking customer, that opening accounts and closing accounts and moving money and doing other things becomes instantaneous, that's a better world. That's what I'm trying to explain. I'm not hopefully not being too critical of regulation, because it's not the regulation itself that I think is the problem. I think it is the way in which the regulations are currently promulgated that is the problem. And I think understanding that technology is your friend is the answer. And so that's really the rant that I'm on, and I'll get off of it now.
Thank you.
I think that's an interesting point. I looked at a Bitcoin ATM startup in the last month or two, and their system, they're taking a picture of the individual, they're taking their license, they're even taking a palm print. And so the KYC is actually, I think, almost better than other banks that offer it. And they can do it in basically 5 minutes. And generally, if you put an ATM in a coffee shop, you can basically do all this KYC, submit it, grab a cup of coffee, and in 5 minutes, they know their customer, and that doesn't have to be repeated again. It reminds me a lot like the global entry system, and I think it's incredibly efficient. It gets all the information you need, and then it allows that person to basically enter the world of Bitcoin and transact without having to have that overhead again.
It's interesting.